The build-up or buy-and-build strategy in the private equity sector involves acquiring one or more relatively small companies and subsequently acquiring other similar companies with the goal of creating a larger and more profitable organization. This strategy is often employed by private equity firms to generate value through the acquisition of companies with strong growth potential, improving their management and integrating them into a larger and more diversified corporate structure. The build-up process in private equity typically involves the following stages. 1. Identification of target companies. Private equity firms identify target companies with strong growth potential that could be integrated into a larger company. 2. Acquisition of the target company. The private equity firm acquires the target company and integrates it into its corporate structure. 3. Restructuring of the target company. The private equity firm makes the necessary changes to the target company to improve management and increase profitability. 4. Identification of additional target companies. The private equity firm seeks further target companies with similar characteristics to the original target company. 5. Acquisition of additional target companies. The private equity firm acquires further target companies and integrates them into the larger company. 6. Consolidation. The private equity firm combines the acquired companies into a single, larger, and diversified company. This strategy can lead to greater growth and profitability for private equity firms, but it also requires careful planning and management to ensure that acquisitions are well integrated and effectively managed. The main advantages of this strategy are the acquisition of the specific know-how and skills of the acquired target company, the expansion of the product range or brand in order to ensure greater market penetration, geographic development in adjacent countries, strengthening the commercial network and seizing specific marketing opportunities, exploiting common competencies and implementing synergies mainly arising from larger volumes and the centralization of many services. Diversification due to entry into unrelated sectors to reduce the cyclical nature of specific markets. However, the build-up strategy is not without risks. Number 1, the first risk is related to the ability to identify companies that can be easily integrated. Any difficulty in integration process will require a lot of time and energy, which will affect the value of the investment. The second risk is represented by the potential changes in the market and the reference market multiples. A decrease in the multiples obviously negatively impacts the valuations, often forcing financial operators to prolong the life of investment in the hope of a quick recovery, thus reducing the IRR, internal rate of return. The success of value creation through add-ons hinges on the continuous ability of potential targets in the market, as well as demand for these targets. If there is a low supply of targets and high demand, valuations will increase, which could diminish the potential benefit of arbitrage strategy on market multiples. Additionally, sector cyclicality may negatively impact the free cash flow (FCF) of the acquiring company, limiting its ability to continue with the acquisition plan. For this reason, sector stability as well as long-term growth drivers, low disruption risk, and high fragmentation are essential elements for the implementation of the strategy. The build-up strategy is based on macroeconomic and sectoral conditions, as well as the financial and operational capacity as well as the financial and operational capability of the acquiring company. It is essential to have a strong infrastructure, a business model that generates liquidity and is repetitive, as well as a wide network of expanding suppliers and partners. For these reasons, a detailed and in-depth due diligence and a well-defined plan for the acquisition of the parent company are key elements for the success of the build-up strategy. Furthermore, it will be crucial to carefully evaluate the capabilities of future company executives and managers involved in the decision-making process. In fact, deal maker will be increasingly unwilling to proceed with a deal if they are not certain that the current management structure is capable of managing change. The introduction of new professional figures into the company should be part of a shared plan and formally accepted by existing managers, who should be actively involved in the decision-making process. Their acceptance of a new, strongly shared project will represent a positive element and stimulus for achieving a common goal. The build-up strategy represents The build-up strategy represents the main investment approach adopted by T-Hub Capital, which aims to be a reliable partner with a strong execution capability, always attentive to quickly adapt to market changes in a historical context characterized by great dynamism.